Good afternoon, ladies and gentlemen. Welcome to this special episode of Market Guru on Business Today Television. I am your host, Shail Bhatnagar, and our guest for today is none other than Mr. Vinit Sambre. He is the CIO for Equities at DSP Mutual Fund. Vinit has been with the DSP for the last 2 decades and has a sterling career managing the mid-cap and the small-cap funds, as also some other schemes. A very warm welcome to you, Vinit. What a pleasure to host you during the festivities that are around us. The market seems to be on a slight back foot, but today's change in stance by the Reserve Bank of India towards neutral opens the door for rate cuts in the economy. That will be beneficial for markets as well. When do you see the first rate cut happening, and what could be possibly the size of this rate cut in India?
Thank you so much for having me on the show, and it's a real pleasure to be on your show today. I think as far as the central bank, the RBI, and the rate cuts are concerned, I think we have seen the first move today with the change in stance. That itself is a good indication of what the central banks must be thinking. And I believe if not December, maybe by February, we should have the first signal, because I think we'll have to still pass through next 2-3 months of maybe a higher inflation print on your low base in the last year. And anyways, food inflation has been slightly on the high side. So maybe once we cross over that hump, we should be thinking about the cuts there. And I think more importantly, if we just look at the trend of the earnings over the last couple of years, post the COVID dip, we had seen a smart recovery on across various sectors. And now, as we talk about the earnings season, the ensuing earnings season, and the quarter which went by, we are clearly looking at some moderation in terms of growth. Maybe due to elections, also the government spend has been slightly lower. So I think with the rate cut expectations, I think there should be some positive momentum which should sort of get built in terms of the growth in itself. And maybe if we are sort of thinking about around 14-15% type of growth over the next couple of years, I think we are in a good spot.
Okay. With that background in mind, Vinit, let's get into the market. The last 2 days, we've seen some kind of how should I say, sanity returning to the markets after a very, very sharp sell-off in the previous 5 or 6 sessions. A 5.7% cut on the Nifty, about a 8 percentage point cut on Bank Nifty, and many other small cap and mid cap stocks have been having a terrible time. This problem within the Middle East, you think has been adequately reflected to in Indian stock prices, or is this a dead cat bounce that we are seeing over the last 2 or 3 sessions, and markets may fall further?
Okay, so let me just try to consolidate a few more things on what you just mentioned. So I think first of all, we have come out of a very massive rally in the markets. Markets have been on a winning streak without seeing any small cuts as well. If you look at every month basis, I think it is more than 50-60 months. We've not seen even 5% cuts in the market. So I think this has been phenomenal and unprecedented in some form or fashion. And I think markets generally don't behave in this fashion. At certain intervals, they keep finding its own maybe pressure points, and it keeps correcting in itself, providing maybe opportunity and due intervals. But now I think after having seen this massive intervals, we all are aware that the market has seen phenomenal rise in the valuations as compared to some of the global markets. We are on the high side when it comes to any matrix. If you look at market cap to GDP PE basis, now some part of it is really justified given where in the economic cycle we are and how the growth has been. But still, we can't say that we are. We have crossed the reasonable levels of valuation. So now, coming out of that high point, I think this small dip, while the oil price linked to the West Asia escalation has been the trigger. But I think overall, we have seen a combination of factors. Like I mentioned, one fact itself is that, the earnings the consensus has started maybe downgrading the earnings somewhat. There is a 3-4% cut in the earnings as we see today. The China has been one of the factors where after having underperformed and the expectation of the push there as far as the stimulus is concerned, I think that has led to the flow also trying to change their directions and looking at the Chinese market incrementally. We have seen FIIs actually pulling out money in the last few days. So I think a combination of all of these and then oil price fear is something which is creating some kind of pressure points. So I think all of this combined together maybe has led to correction. And I think it is always going to be such that one specific event could be called as a starting trigger, but then there will be a combination of factors. So as we see sit today, I think the good part about all these geopolitical issues till now has been that oil has not misbehaved. Only the last few days it has gone up. So I think if oil generally doesn't become uncontrollable, I could imagine that markets will not take it very negatively. That is number one. Number two, more importantly, I would say that as we go through the earnings season over the next 1 or 2 quarters, maybe market could look to consolidate given how the earnings are panning out. And on these valuations, I don't see room for further valuation re-rating. So I think a
Okay.
large part of the market, direction will depend upon how the earnings outlook come by. And there, I think there is some bit of moderation, and hence I would say call it maybe some bit of time correction or some consolidation in the market is something which is warranted. And that is how we are sort of thinking over the next maybe course of 1 or 2 quarters out here.
Okay, that's a time correction and earnings moderation. Is it that a euphemism for markets to maybe dip further, Vineet? On the Nifty alone, what would be, to your mind, a good level of the index which reflects this earnings moderation as also maybe froth being taken away? The worst that we've touched is at 24,700. I understand that fund managers typically don't look at the index level as such, but what according to you would be a good entry point for long term investors to deploy cash?
I mean, so again, as I said, while it's very difficult to call out levels, but I think in general, we are at maybe 21, 22 times on a 1 year forward basis, where also maybe earnings could see some bit of, 2-3% of downgrades. So, I mean, building that in, if we come closer to between 19 to 20 times, I think in the current context where uh, we assume that the overall long-term growth is for any reason is not getting affected, then I think that 19-20 times is a decent multiple. While we used to think about 17-18 times as a decent multiple, but now in the context today where the mix of the index is also changing, you have companies where in general the P's have been higher, so we have to maybe bring that in when we think about the reasonableness of the valuation. So I think somewhere we can say that 7-8% kind of cuts if we see in the markets, those can become the first maybe point to sort of think about companies which might have seen slightly sharper cuts, and then to depending upon the long term outlook to look at those at that point in time.
Fair point. So 7-8 percentage point downtick from a record high. Of that, about 5 odd percent has already happened. So pretty much we are in a buy zone as far as the Nifty is concerned. Vineet, you've traditionally been a very good stock picker for the mid cap and the small cap space. That's your specialty at DSP. Tell us what is your gut feel about these indices? They've rallied very sharply over the last 9 odd months, outperforming both the Nifty and the Bank Nifty by a huge margin. Are these valuations making you uncomfortable, or is the buy and hold strategy still in place?
No, so clearly the valuations have moved up quite significantly, and it is not comforting when we think of the quantity of business which we can buy at maybe reasonable valuation. So the margin of safety keeps coming down as the valuation keeps going higher. So the only point which I would like to sort of put here is as far as the this whole economic growth is concerned, we are looking at a very broad-based economic growth in India, and that is something which is important from sustenance of the mid cap and small cap, momentum over the long periods of time. So I think to me, I think when I look at a lot of the sectors beyond the top sectors, be it real estate, be it agri-related, be it textile, building materials. I think there are so many of them where there are relevant businesses, relevant companies, leading companies, and the economic cycle is all sort of benefiting them in different cycles or different periods of time. So I would say that over the long term we remain bullish irrespective of the valuation, but just that keep giving respect to where we are in the valuations and not going overboard. The best way or best form to participate would be to stagger, go with an SIP kind of a mindset and think about this category, investing into this category for let's say 7 8 years. I think the differential in the returns which a mid and small cap generally tends to create as compared to the large cap is because of the earnings power or higher earnings growth which these segments do provide. And if you look at the long, let's say the 10 15 years history of the indices, the mid caps have tracked the higher earnings growth, the small caps have tracked slightly even higher earnings growth, and large caps have tracked at 12 13% kind of growth. So assuming that these kind of growth keeps sustaining for the next decade or so, we are I think comfortable assuming that these categories should keep outperforming. Just that at a point in time today, one has to be a bit cautious and not expect a very high returns from the valuation point where we are today.
Absolutely. That's a very sensible statement, and I hope a lot of investors who are working towards doubling their money every month may pay attention to this very, very thoughtful and practical approach that from now on you have to curtail your expectations of earnings and be very cautious, because the underlying earnings of the Nifty and corporate India may moderate going ahead. Vinit, the DSP Midcap Fund has given a CAGR return of almost more than 19% over the last 14 years, and has an AUM of about 20,000 crore rupees. I am looking at your portfolio. A lot of market participants seem to be working towards raising cash in their portfolio. What would be your level of cash as a percentage of AUM in DSP mid-cap and small-cap funds?
So we are close to, let's say in mid cap, we are close to 4.5 to 5% cash as we speak. And in case of the small cap fund, we are closer to 6 to 7%. But generally, even in the past, we have not worked with cash as a strategic thought process. Generally, our assumption is that when investors are allocating capital to us, they have themselves taken their cash calls, they have done their asset allocation, and the money which comes to us is largely to remain invested in equities. And also, maybe if we look at the long-term picture of India, equity for us is a good long-term asset class which will keep generating returns over the inflation. And hence, we believe that tactically holding on to cash also sometimes doesn't work, because the timing could go wrong, and markets can keep sustaining the momentum irrespective of the high valuation. So I think from all these viewpoint, we have generally remain invested, and I think that is a good. I mean that we found more comforting. And at any point in time, we are also when we are talking about the market highs, we also would be looking at some segments which have not participated equally, some segments which are seeing low cycles, and hence one can think of utilizing that cash and investing into segments which have been on the lows, and there could be signs of recovery out there. So I think that is how one can maybe make the best use of cash, and we would like to generally remain invested and not take tactical call around the cash positions.
Fair point. The DSP Small Cap Fund has a corpus of about 16,500 crore rupees, and since the launch in 2007, the CAGR is a very strong 19%. Vinit, I'm sure you are also grappling with this problem that the sectoral churn in the market is very quick. There were times when you would see a rally easily going up for 1 year in a particular sector. Now I don't know whether because of Robinhood traders or this mad rush to have everything very quickly, rallies last for about 3-5 months, and the quiet period has also come down dramatically. This is an opportunity for many, but for fund managers such as you, who take very tentative steps and very thoughtful picks, this seems to be a difficult terrain to navigate. How are you sort of overcoming your initial hesitation at sort of trying to time the market rather than spending time in the market?
No, sure. I think this is a very important point which you brought up, and especially post COVID, we have seen this phenomenon where the sectoral rotation has been pretty quick, and the themes and the fad, they catch up momentum very quickly, and then they the money keep chasing different segments. So I think if we just maybe look at one data point post the election, while we had seen one dip at the time of the election, June 4th, and the markets have recovered. But if you look at the mix of the market or the texture of the market, that has changed. And across the large cap, mid cap, small cap, if you just plot the quality index of all of these broader indices, the quality has started outperforming the broader indices. So let's say a mid cap quality index would be now outperforming the mid cap index. The small cap quality is outperforming, which means that what we had seen in terms of the sectoral rotation to some extent was driven by how each sectors were also seeing business recovery, and then followed by a lot of chasing of momentum and liquidity. But now I think all that should also normalize, given the fact that the overall earnings up move is also not going to be as volatile as it was in the last 2 years. And hence, I would say that the kind of that volatility which we saw, or that quick change which we saw, would not be in the same proportion as it was previously. While we will keep having these, short-term quick moves, we'll have these themes, these fads will keep happening. But I think on the whole, it should not be, in the same proportion at it used to be. And hence, I think that for good companies, good quality businesses, I think the next few years should really turn out to be good years is my personal assessment.
Okay. My final question to you, Vinit, is on the way ahead. Just a gut feel. Will large caps outperform mid caps or smalls, or will mids and smalls still rule the roost?
Yeah, I think again, very difficult because different timelines. But let's say in a very near term, given the fact that the mid caps have run up so much, I think if we look at the valuations between the three, the mid caps have reached the highest point today, and followed by small cap, and then followed by large cap. So just going by the same metrics, I think in the near term, and as we are getting into some bit of these headwinds, in some of these areas, I would say that there is I think some shift towards safety, some shift towards
Yeah.
large cap, and is what is seen, and hence it is likely that in the near term we do well with the large cap in terms of the allocation. Long term, I would still continue to have my strong views around mid and small caps, but near term definitely it makes sense to look at the large caps.
Okay. Vinit, we'll end it here. And just behind you are three tigers. I'm hoping each one of them represents the small, the mid cap, and the large cap funds that DSP has been offering to lots of long term investors, and they've made some great returns there. Here's wishing you all the best in terms of navigating the volatility in the markets, and of course, festive greetings to everybody at DSP. Thank you so much for your time.
Thank you so much. Thank you so much.
With that, ladies and gentlemen, Market Guru draws to a close. But this was a conversation with stock picker Vinit Sambre, who's the CIO for equities at DSP Mutual Fund, and he was discussing his small cap and mid cap scheme, which over a period of time has marginally underperformed the larger indices, but overall have given fantastic returns since they were incepted in January 2013 and June 2007. I hope you enjoyed the conversation as much as I did, but stay glued to Business Today Television. There's a lot that's happening on the other side of the break.
Prime Minister Modi and I held extensive discussions taking stock of our successful development journey together and charting a path for the future collaboration between our two countries. We agreed on a comprehensive vision document charting the course of our bilateral relationship, a vision for comprehensive economic and maritime security partnership will encompass development cooperation, trade and economic partnerships, digital and financial initiatives, energy projects, health cooperation, as well as maritime and security cooperation. India is a key partner in the socio-economic and infrastructure development of the Maldives and has stood by the Maldives during our times of need. I would like to thank Prime Minister Modi, the government and people of India for the generous assistance and cooperation extended to the Maldives over the years, including the recent budgetary support in form of rollover of the T-bills. I am thankful for the Indian government's decision to provide support in the form of 30 billion Indian rupees in addition